I know that this is the tough spot at 11:20. Everyone's starting to think about lunch. But before we get going, and don't worry, there's plenty of food. It's not going to go away. I'd love to just ask people in the audience, show of hands, how many people are users of tech, have discovered an app or a new product, or met some people they're really passionate about what they're doing and would love the opportunity to invest on a personal basis? There are lots of people like us out there, and that's why we've created Quire. And first, I'm going to take some steps and walk you through some basics, Equity Crowdfunding 101, just to make sure we're thinking about the words the same way. And then I'll talk to you about what we're doing and what makes us different in the equity crowdfunding space. But first, an opportunity to make a pitch to all of the students who are in the audience. This is a treasure map. It is a random path. There was absolutely no plan in my getting to this point, and I think that's the key takeaway. A lot of entrepreneurs that you talk to, they didn't wake up thinking, I have this great idea, it's the only thing I want to do. A lot of times they stumbled upon it because there was a problem that was really vexing them and they wanted to solve it. They may not have started entrepreneurship right out of the box. They might have gone the consulting and the banking path. I learned a lot of great things doing that. So just think about what you want to do, why you're doing it, and make sure you're getting what you want to get out of that as you move through your path. And when you're not getting what you want, time to move on, and that's okay. And that is my dog, by the way. She's awesome. So Equity Crowdfunding 101, there are 4 types of crowdfunding. Everyone's probably pretty familiar with Kickstarter and Indiegogo. Anyone participated in a campaign on either of those platforms? So that's rewards-based. You donate money, you get a t-shirt, you might even get a Pebble watch. The product may or may not arrive on time. It may not function when you get it, but you know it's a donation. Donation, like pure donation, CrowdRise, everyone's probably seen a lot of donation options around the Nepal earthquake. Great example. Then we have lending, one of the hottest IPOs last year, which has really put the whole peer-to-peer and crowdfunding space on the map. Absolutely incredible. Good, long-term, and a lot of history in the UK and other environments. And then we have this space called equity crowdfunding, and we're clearly in that, and that's what I'm going to talk about today. So some keywords. Everyone knows IPO, initial public offering. That is obviously a very laborious regulatory process. It requires an S1 filing. You have to file with a bunch of states as well. Whole lot of details that have to be provided. Very time-consuming, extremely expensive. There's a lot of great data out about the shift over the last decade in capital raising and how the private markets accounted for a very, very small percentage of capital raise even 15 years ago. And today they're on path to kind of equal the amount of capital that companies are raising through the IPO process. We'll talk about why that's meaningful for equity crowdfunding in a little bit. Jobs Act. Obama signed into law in 2012. A lot of promise, a lot of hype, really exciting, and some major changes to laws that were drafted in the 1930s in response to the Great Depression and what happened, and a lot of people literally losing their money overnight through fraudulent investments in equity capital markets. The biggest is, or one of the biggest, Title II. Title II refers to Regulation D, or what we would call private placement offerings. Those have existed. They've been around for a long time. They're actively used. What Title II did was it allowed the general solicitation of those offerings. So that means you can actually go out and market to anyone in the public the opportunity to invest. What Title II did not do was change the accreditation rules, and it said while anyone can find out about an opportunity, in order to invest, you still have to be an accredited investor, and we'll talk about that in a second. Title III is the thing that got a lot of hype around equity crowdfunding. What does Title III mean? Like, that is true market to anyone and everyone can invest. You could invest as little as $50. You could invest if you wanted $100,000. The rules as proposed and drafted have some limitations. Right now, you would be capped as a company at a total raise of $1 million in any trailing 12-month period. There's been a congressman who's proposed that limit be increased to 5 million, but there are still some rules and protections in place that are valid, questions around how easily those will be implemented, but looking at the percent of your income and or the percent of your net worth that you would be able to invest in a true equity crowdfunding situation. Interestingly, anyone here listen to the podcast Startup, Alex Blumberg? Pretty entertaining. It's actually great. We did an equity crowd raise for those guys, and we were on the podcast. But I believe it's episode 6. He talks a lot about equity crowdfunding. He has an on-record comment from a member at the SEC who basically says it's a terrible idea, and we don't believe in it. So we've been waiting now for 2 years for the rules to be passed, and we're doing what we can. Maybe October 2015, something will happen. Then the last, which was just recently passed about a month ago, is Title IV or Reg A+. Regulation A was a mechanism. It's been around again for a number of years. It allowed companies to raise up to $5 million with what was called a light IPO process, so very modified filings with the SEC. The SEC put new rules out. There was a surprise component, which was they've actually opened it up to the general public, so now anyone can invest. In the past, it was only qualified investors. And they've also increased the limit, which was mandated by Congress, to $50 million. It's super interesting in terms of the opportunities that it's creating. However, we, at least on our end, are pretty cautious about how many companies are actually going to use it, particularly companies that are already in the private market and or have access to private capital. Because the Reg A+ process still has a reporting mechanism, your shares have to be publicly traded, and you have some ongoing filing and initial filing requirements. Even though they're light, it introduces complexity and it introduces cost in what is a relatively frictionless environment for private placements and venture capital. So Mark Andreessen, heard his name a lot in some of the presentations earlier today, has gone on record, as have several people, that one of the big issues around this is the amount of wealth that's being created in the private markets. Because companies are delayed in going public, and or a lot of these companies are also being acquired before they even become public. For us, we're on a mission here, and that mission really is fair access and it's education. There is a lot of controversy around should the general public actually be allowed to invest in private companies. They're incredibly risky. We think that they should, and we think there's some ways that transparency can be handled so people can make educated decisions. And let's start teaching the public how to fish. And as you heard this morning with what Betterment's doing, there is a real movement, particularly in retail financial services, around personal accountability and preparedness and giving people tools to make good decisions. And we squarely fall in that camp. There's another piece, too, that students think a lot about, both in undergrad and grad school, when you're looking at all of these different models of how economies could run. Capitalism is one we're all quite familiar with, but there are a number of others. One of the key takeaways in a lot of these conversations is how people actually connect with businesses and with the world around them. And we also think that the ability to connect with these early stage companies through the investment process is a really interesting way to both influence the development of technology and to feel like you're a part of that tech instead of someone who is kind of being acted upon. And it's very personally rewarding. So who is Quire? We've already talked a little bit about kind of what's happened in the past. So capital formation has really typically been, and companies, we create this product, we sell this product to people, and you get to use it. Then maybe you get to participate in value creation through the IPO process, but that's really been about it for the public for the last 100 years, definitely even currently. We really do believe that there is a better way to connect the users of your product, the people who believe in what you're trying to do, with the founders and the creators of all of this new tech that's happening. And it is literally changing the way that we're living. And that's why we've decided to exist. So we market all of our opportunities through general solicitation, which means direct access to the public to invest. We focus primarily on companies that have active communities and have individuals who discovered them super early on, might have tweeted about them, might have blogged about them, might have actually gone down to the company's small ad hoc office space and kicked around some of the prototypes that they're developing, might have contributed to open source code development. Those folks are incredibly powerful. They really believe in what you're trying to accomplish as a founder, and they've actually helped you create your product, and we think this is a great way to reward and enhance their loyalty. The other thing that's unique about what we're doing is all of our deals are backed by a venture capital sponsor, and we'll talk about why that's important in a little bit, but it gives a great kind of good housekeeping seal of approval, to use a very old-fashioned term that maybe not everyone in the audience is familiar with, but it's comforting, it's validating, and you're now co-investing. So we're taking investing from this to this. And we hope that everyone looks as great as the people in the picture on the right. And a lot of you are probably familiar with Esther Dyson. She has a great quote. And actually at NYU, they have an entrepreneurship center, and there are steps, and that's how I discovered this quote. And they have quotes on each of the steps going up. And one of them is this great one from her saying, "Your customer is your best investor." There are some real stats, actually, that support this. This is from a Bain & Company research report that they did a little while ago. You'll see it a lot. Loyal3, which does what we do for companies but through the IPO process, they recently did the Virgin America IPO, which was a tremendous success. They quote these stats as well. But you can see some huge, these are meaningful differences in impact of behavior of people who are engaged with your product and are owners of your company versus people who aren't. This can really start moving the needle, and for a young company, when we're starting to get these numbers at scale, this can make an absolutely huge difference. The other thing that it can do for younger companies is, you talk a lot about in the VC community and certainly in startup world, there's a huge leap to go from that seed funding round to get up to Series A, true meaningful venture capital. And by working with your community, accepting community investment, you're validating what that opportunity is. You're showing your breakout potential. You're showing this path to acceleration and adoption. And that can also be really helpful. And there's a great statistic that you can see up here which says you are much more likely to get venture capital funding in that A round if you actually have raised meaningful money from your community. So we'll stop for a moment. We raised money for Giphy, so we love gifts at our company. But let's stop and talk about risk. How do we handle it? What does it mean? It takes a lot of shapes and flavors. On one end of the spectrum, there are a ton of people, even in the equity crowdfunding space, who believe only accredited, sophisticated investors should have access to these opportunities. Then there's just the simple fact that investing in private companies is super risky, and the likelihood of you losing your money is extremely high. So two things to consider. How do we manage those? The biggest for us is the fact that you are co-investing along a venture capital, along with a venture capitalist. So these are firms that actively sponsor deals on our platform. We'll be announcing some new VCs over the course of the upcoming weeks. One of the VCs who isn't up here is Lightspeed. Lightspeed led the Series B round for Giphy, and there was a carve-out for Giphy's community and other passionate followers to let them invest alongside. And literally, what do we mean about investing alongside? If it is a Series B preferred equity, you are getting Series B preferred equity. You're getting the same purchase price that Lightspeed negotiated for their LPs. There are some minor differences. Those are around information rights, voting rights, and follow-on rights. We disclose those very, very clearly so people understand what the differences are and what is the same. Some of that's because it's just logistically very difficult if you have a group of people to exercise follow-on rights in a really rapid time frame. But a lot of disclosure. It gives, I think, individual investors comfort. It solves for the problem of adverse selection. The last thing we want our investors to feel like is a company couldn't find investment anywhere else, and so they're going to them. No, that's not true at all. These founders think you're important, and they are inviting you into the investment opportunity. The other thing we do is we ask an individual who is investing to acknowledge at 3 different points in the process that they can afford to lose their money. So, if you can't afford to lose this money, it is probably not the right investment opportunity to you in terms of your risk profile. This is a quick case study. Gimlet Media, again, the podcasting company. We had $700,000 worth of demand for $200,000 of opportunity. That entire process opened and closed in 200 minutes. So this can be extremely powerful for companies. And while a lot of equity crowdfunding platforms, it might take weeks or even months to close rounds, we're closing rounds in a matter of minutes. So, accreditation. This is, kind of the big elephant in the room. What does it mean? We had a great tweet. We rebranded a week and a half ago, and we ended up with thousands of tweets. It was pretty incredible, all coming from individuals who really believe in the community aspect of what we're doing. So Josh pointed out that this whole community thing is awesome, but the SEC defines, community investors as net worth of over $1 million, excluding your home, or income for the prior 2 years of $200,000 and being on that same path this year, or $300,000 if you're an accredited or you're married filing jointly. What does that mean statistically? Only 2.5% of the American population, so babies on up, or 4% of kind of broadly defined working Americans, ages 18 to 65. That is a fraction of the economy. Not a lot of people getting locked out of this opportunity. So what have we done? Because the rules are the rules. Being attuned to the regulators is super important. We misstep. It's a disaster for our companies. It puts us out of business. There's nothing we can do to let unaccredited investors get into an investment opportunity until Title III rules are written. So what we've done is we want to create a way for people to feel like they're an owner of the company if they're not actually able to invest in the company. And we've done that through a follow button. We're going to be rebranding the follow button a little bit later so that it sounds more action-oriented instead of passive. But what we're doing, we found with Gimlet that for every person who was able to accredit and invest, and almost every person who accredited actually made an investment, and if they didn't, we had to cut them off because we couldn't take any more money, there were 3 people who couldn't invest. We found with Giphy, for every 1 person who accredited to invest, there were 10 people who couldn't accredit but wanted to invest. Those are some pretty big numbers, and as we start raising bigger amounts for companies, that really is opening up a huge funnel. We want these folks to get involved. We want them to be involved in a meaningful way, and our companies want to access them and have them help. So what does it actually mean to follow and to build in public? And that's really what this follow button is about. It's a commitment to building in public. And there are 3 core values around that. The first is transparency. You could see this in the podcast called We Made a Mistake. Literally, these guys made an unbelievable error, and it was the type of thing that if they didn't handle it quickly, it would have really put them behind the 8 ball for quite a long time, and they could have been dealing with that, highly distracting. They literally did a podcast, an entire 25-minute issue, on the huge mistake that they made and how they went about resolving it. Ended up huge home run for them in how they handled it. Tons of transparency, openness, and honesty. Collaboration. Everyone here probably follows Ryan Hoover Product Hunt on Twitter. Huge investment from Andreessen Horowitz just coming out of his seed round. He's kind of the ultimate in transparency. When they were launching their mobile app, he used Meerkat. I don't know if anyone's used that, but literally was streaming live screenshots of what the coding process looked like, what the app was going to look like, asking for real-time feedback. I mean, he is out on the bleeding edge of transparency, and not every founder is comfortable with that. We're allowing the founders to decide what level of transparency they want, but great example. And then engagement. Engagement is about doing more than just telling your customers about a new product. It's about, again, creating community around what you're doing, helping people meet new people, similar to what we're doing with the FinTech Conference today. Just, again, very compelling, and it's making your brand live and breathe. So, again, another pitch. If anyone knows any companies that they think would be great for the platform, if you're starting a company and you're looking for backing, or if you're particularly passionate about community, we would love to hear from you. So my contact info is up here, and the head of business relations, who's a really passionate, deep thinker about these topics, also feel free to reach out for him. And on that note, we'll open it up for questions. So these are just thumbnails of deals that we've actually done, and they show the range of raises that we've done for companies. Yeah?
Erin, thank you for the talk.
Sure.
I can see a company that I think is a dual list. Are they in the same space, I believe? And then secondly, I think one of the things that AngelList does is syndication. So if I'm an investor, I can get a number of followers who may invest with me on the companies that I invest in. Mm-hmm. And I think you're positioning more as following the VC companies, but you have an option to syndicate it.
We don't have a syndication option because the VC is really the equivalent of the syndicate leader. So it's come in, invest, you're co-investing with them. Syndication is interesting because of the ripple effect of rapidly accumulating capital, but we feel that you really need that validation point and a professional, established investor who's raised money from LPs, and that's a better investor protection for us. But yeah, AngelList is definitely in the same space. Big difference is they have a completely open platform where any company can list, and we have a controlled platform where only companies that are VC-backed can list. Yeah?
Can you talk a little bit more about financial transparency? I know you mentioned that transparency was one of the things that in your contract will be slightly different. Does that mean before you invest, you get to see company financials, and along the way, you get to see company financials? How does all that work?
As an investor, you get regular investor updates from the company, and it depends on what the founders decide to disclose. Typically, they'll talk about revenue metrics and growth. I mean, it's a great question because early stage companies don't really have financials. And what you will see in a pitch deck, and our pitch decks are up, they're on the web, anyone can look at them. It might have a pie chart that says, you know, this is roughly the breakdown of how our expenses are going to be handled and the amount of cash. This might be our monthly burn rate. This is how we're going to use the money that we're raising. But beyond that, like a 3-statement financial presentation is just a level of sophistication that's not realistic for where these companies are. But you do get some disclosure to financial information once you get into the investment process. Yeah?
What is Quire's revenue model? You take an equity stake, you take a fee, you take a percentage of the capital raise, or?
Right now, we are absorbing all of the expenses. So another theme that you hear a lot is using technology and passing those benefits on, or the efficiencies that it provides, by low cost to the customers who use the platform. So we take carry on all of our deals, and we take 10%. So our interests right now are completely aligned with the investors who are going into the opportunity. Other questions? Yeah.
In terms of financially, what is the real difference between becoming an LP of a venture capital? It seems that you yourself is kind of like a venture capital, and you're funded through a crowd equity funding platform.
You are, in a way. If you invest through us, you're kind of like a little mini LP. The biggest difference is, unless you're willing to write $100 million, $250 million check to get into the VCs, it's just not accessible to individuals. And even for seed funds, the ability to make an investment is a fairly high standard. So this allows people access to opportunities that they'd otherwise never have access to. I mean, the quality of deals that we're able to bring to the table because they're VC-backed is really high. And one of the metrics that we look at is the percentage of our companies that go on to raise follow-on financing, and right now we're at 100%. So no one else in the equity crowdfunding space could say that. Yeah?
What do you do for accrediting your investors?
We actually use Second Market. Oh, you're not Second Market, you're Betterment. So Second Market split with the digital group. But as you go through the process, an individual uploads documents that are encrypted, so it's completely secure. Those are sent to Second Market. Second Market then reviews. You also have the option to use a third party to do an attestation form, so it could be your accountant or your lawyer. And then Second Market reps to us that everyone making the investment is accredited, and we provide that rep to the company as part of our execution of their purchase agreement. Yeah, in the back.
Hi, yes, a question about the writing of the rule that allows unaccredited investors to start investing. I guess, hopefully for your sake, for everyone's sake, that gets written soon. But is there, just out of curiosity, is there an unintended consequence of that, in that it helps in a way where it can be that this obstacle can be used to generate buzz, because unaccredited investors might like to invest, but they can't, and so it kind of builds pent-up demand. So once it's written, then in a way it might be doing you a favor. But is that something you've seen, or you kind of, or is it? I'm just interested in what your perspective.
Sure. I mean, and let me know if I don't answer the question as you intended. But there's a ton of just general public interest in the ability to invest in these private companies. And I mean, clearly when you see Facebook's success or Uber's success, dollar signs are going off in people's eyes and they want that opportunity. So, that's one reason why we have the 3 stages as you're going through the invest flow. Can you afford to lose your investment? Because we don't want, one of the big concerns and the biggest concern for the SEC is we're going to be literally rolling back to 100 years ago when people were investing on momentum and pure hype and excitement, and they weren't thinking through the opportunity. So we think the better way to address that is not to prevent people from investing, even if behaviorally they might get really excited, but instead to focus on the platforms that are providing these opportunities to make sure we don't have bad behavior. So those are the folks who are being held accountable. And we personally believe we can moderate for that through the VC-backed investment opportunities, an education center which we'll be launching over the upcoming months and quarters, which will do a lot of deep diving in various topics, including what happens in a down round, or what happens when you have $1 billion invested in you at a huge $42 billion valuation, and all of the protections that those investors receive, and as a result, what that might mean to you for payout. And we'll be explaining it in really simple, easy terms with some quizzes at the end so people can feel confident that they internalized the lesson. Does that help?
Thank you. That was also good to know as additional color. I guess I'm just curious from a publicity perspective, is it actually a positive unintended consequence of this rule not being written? Because everybody wants to, but they can't, so it kind of psychologically makes people more interested.
I mean, it could. I haven't done a lot of thinking on that. I mean, there is a lot of kind of press and chatter and talk, and that's why these follow statistics are really interesting, and the number of people who want to invest but can't, we're capturing their information and we're helping them get involved. It probably does help quite a bit. You could see it in the number of tweets that we had from individuals when our announcement and rebranding was changed. Awareness is a good thing. Thoughtful action after you're aware of something is the best outcome. One more question? All right, cool. Thanks.